Welcome to vTalkInsight, Risk Sentiment Daily for December 23, 2025. Global markets are ending the year with a powerful mix of risk-on, equity momentum on one side, and rising stress signals from yields and gold on the other. Let's unpack what that balance means for today's risk sentiment and the key forces driving it. Risk sentiment today is best described as cautiously risk-on. Equities continue to grind higher, with the S&P 500 rebounding over recent sessions and volatility indices back near the mid-teens, signaling steady risk appetite rather than fear. What stands out is how broad the advance has become. The S&P is on track for a seventh or even eighth consecutive month of gains, and leadership has rotated away from a narrow set of artificial intelligence winners toward healthcare, financials, materials, transports, and other cyclicals. Stronger market breadth is being reinforced by constructive fundamentals. Earnings expectations have been revised higher, with forecasts calling for around 14% S&P 500 earnings per share growth next year, underpinned by AI-driven productivity and solid profit margins. On the macro side, private and bank forecasts point to real GDP growth in the 2.5% to 3% range, and several houses expect inflation to settle below 3%. That combination underpins a soft landing baseline that is supportive for risk assets. At the same time, the risk-on tone sits alongside some clear warning lights. Global long-end yields are pushing higher, gold has surged nearly 70% this year, and safe haven demand remains intense, all of which hint at deeper concerns about inflation, policy, and geopolitics. There are also questions about stretched valuations and concentrated exposure in megacap AI names, as well as growing expectations that volatility will pick up materially in 2026 even if equities hold up. So the current regime is constructive, but it is increasingly late cycle in feel, with a need to watch both the durability of the rally and the behavior of defensive assets. A key bullish driver is the broadening equity rally and market breadth. What began as an AI and megacap-led surge has widened out, with gains now coming from healthcare, financials, materials, retailers, industrials, and transports. Commentary notes that banks, retailers, and industrials are all participating, with transports like CSX and FedEx posting several weeks of consecutive gains. More stocks are making 52-week highs, and a larger share of the market is trading above key moving averages, signaling that this is not a one-sector story. Flows and positioning are reinforcing this breadth. There is talk of a potential year-end melt-up in equities, helped by low selling pressure and an absence of natural sellers into the final weeks of the year. Estimates that the S&P 500 could reach around 7,700 by year-end imply another year of double-digit gains, while other projections see 12 to 15% total returns next year if the economy avoids recession. These expectations reflect confidence that earnings and liquidity can continue to support higher equity prices. Under the surface, leadership is also shifting. There is a noted global rotation from US-centric AI and tech themes toward more cyclical laggards, driven by expectations of fiscal support and a pickup in growth outside the US early next year. The reopening of the IPO market, especially for sponsor-backed and AI-related deals, adds another sign of risk appetite, providing liquidity to private markets and re-engaging investors in new issuance. Looking ahead, the sustainability of this broad rally will hinge on whether earnings delivery keeps pace with optimistic forecasts and whether sectors beyond technology can continue to carry the baton if sentiment toward megacaps cools. The second major bullish driver is the Fed easing bias and soft landing narrative. Policymakers are signaling that they are comfortable with steady or gradually lower policy rates, with some officials open to 25 or even 50 basis point cuts at upcoming meetings, depending on data. Recent inflation prints have generally been cooler, the unemployment rate has ticked higher, and key inflation components like shelter, labor, and energy are showing subdued pressure. Several forecasts see consumer price inflation around 2.8% next year, which is close enough to target to reduce urgency for further tightening. This backdrop feeds directly into soft landing expectations. Bank of America, for example, projects U.S. growth around 2.4% in 2026, outpacing other major economies, while other private sector forecasts see real growth near 3% if labor markets remain resilient. In that scenario, rate cuts in the first half of next year and into 2026 support small and mid-cap companies that rely on variable rate credit, as well as rate-sensitive sectors like housing and consumer discretionary. A modest steepening of the yield curve, driven by lower front-end rates, is expected to further aid these segments. Positioning adds another dimension. There are still large amounts of cash parked in money market funds and short-term deposits, reflecting lingering caution after the hiking cycle. As the Fed maintains an easing bias and inflation trends lower, that cash is expected to move first into short-duration bonds and, over time, into risk assets as cash yields decline. Options markets are also expressing significant interest in a bond rally, with some positioning for 10-year Treasury yields to fall below 4% in early 2026. The main risk to this benign picture is that unreliable inflation data, political developments, or aggressive pre-election fiscal moves reignite price pressures, forcing the Fed to pivot back toward a more hawkish stance. For now, though, the center of gravity remains on an orderly easing path that extends a cycle rather than ends it. The third bullish driver is the AI-driven earnings and growth cycle. Major AI players such as NVIDIA, large cloud providers, and enterprise software firms are reporting strong growth, raising guidance, and pointing to sustained demand for accelerated computing. Analysts expect a multi-year capital cycle in AI infrastructure, with some forecasts calling for annual growth rates above 20% and high margins for at least the next 5 years. This investment wave spans chips, data centers, networking, and increasingly the software and security layers on top. Importantly, the AI theme is no longer just about top-line excitement. It is feeding into macro and earnings forecasts. Consensus S&P 500 earnings growth hinges in part on record-high operating margins, which many attribute to AI-driven productivity gains and automation across industries. Recent upgrades to earnings estimates are broad-based, extending beyond pure technology into sectors like industrials and services that benefit from efficiency gains. This supports the view that AI can help sustain above-trend profit growth even if nominal GDP growth is only modestly above 2%. There is also a sense that the AI investment cycle is still in its early innings. Volatility around AI stocks is increasingly framed as an opportunity within a decade-long build-out, rather than a sign that the theme is over. However, capital is becoming more selective. Investors are differentiating between likely winners and potential losers, and regulatory scrutiny is rising as states like California and New York impose AI safety laws with meaningful penalties. For markets, the key question is whether the realized return on this extraordinary capex cycle matches current expectations. If it does, AI remains a powerful tailwind for both growth and equities. If not, it could flip into one of the more significant sources of downside risk. On the bearish side, rising global yields and credit risk are an increasingly important counterweight to the risk-on narrative. Japanese 10-year government bond yields have moved above 2% for the first time since 1999, while Australia's 10-year has risen around 50 basis points in a month. In the U.S., the 10-year yield is up and the 230 curve has steepened sharply, with some observers watching for the 30-year to revisit 5%. These moves are being driven by a mix of Bank of Japan tightening, fiscal concerns in Europe, and hawkish signals from the Bank of England and others. Higher long-end yields create several challenges. They put pressure on equity valuations, particularly for long-duration growth assets, and they limit the traditional hedging role of government bonds in multi-asset portfolios. At the same time, credit spreads remain tight, offering limited compensation for default and downgrade risk. If growth were to roll over into a hard landing, spreads could widen sharply from current levels, leading to meaningful price losses for credit investors. Looking ahead, many expect a twist in yield curves, with front-end rates falling as central banks cut, while long-end yields stay elevated or even drift higher due to term premia and fiscal supply. That pattern would keep mortgage rates and discount rates for long-duration assets relatively high, even as short-term funding costs ease. Monitoring how equities, real estate, and credit respond to further upward pressure on long yields will be critical for assessing whether today's risk-on tone can persist. Another key bearish driver is the intensity of safe haven demand and the gold surge. Gold has delivered gains of roughly 2/3 to 70% this year, rising to record highs and nearly doubling its long-term moving average. Silver and copper have also broken out, and broad metals strength is evident across aluminum and steel, reflecting a mix of robust demand, supply constraints, and rising inflation expectations. The drivers of gold's move are telling from a risk sentiment perspective. Expectations for lower U.S. policy rates, a weaker dollar, persistent inflation above 2%, and ongoing geopolitical tension around Venezuela, Ukraine, Taiwan, and broader trade disputes are all pushing investors towards safe haven assets. Market consensus is strongly bullish on gold, with some banks projecting prices around $4,400 in early 2026 and pointing to continued central bank buying. At the same time, the magnitude of the move has raised bubble concerns, with historical patterns suggesting that extreme extensions often precede corrections. Gold's strength alongside currently low equity volatility is being read by some as a sign of an impending regime shift. One scenario is that equity volatility rises meaningfully next year, with potential downside for major indices even if the economy avoids recession. For cross-asset investors, the behavior of gold, safe haven flows, and volatility markets will be important indicators of whether today's calm risk-on conditions are stable or simply the quiet before a more unsettled phase. The final bearish driver is AI and mega-cap valuation risks. A small group of large, AI-focused technology stocks now dominates major U.S. indices, creating a concentration that leaves benchmark performance heavily dependent on a few names. Free cash flow yields for these firms are at or near record lows because of extraordinary capital expenditure, particularly on data centers and AI infrastructure. If returns on that spending fall short, valuations could reset sharply, dragging broader indices with them. There are already signs of market unease. Observers point to speculative behavior and complacency, with warnings that leading semiconductor names could underperform in 2026 as investors rotate towards software and AI security plays. Regulatory risk is also building, as state-level AI laws require incident reporting and risk management frameworks, creating a patchwork of rules and higher compliance costs that could slow innovation. In parallel, optimism around some crypto and private AI assets is being reassessed, with talk of mean reversion in Bitcoin and potential problems at high-profile private firms that could spill over into AI sentiment. Together, these factors suggest that while AI remains a powerful growth engine, it is also a focal point for potential derating if expectations move even slightly off track. To sum up, today's risk tone remains cautiously risk-on, powered by a broadening equity rally, an easing bias Fed, and a powerful AI-driven earnings cycle. Set against that, higher global yields, intense safe haven demand, and elevated mega-cap valuations are clear reminders that the current regime is late cycle and increasingly sensitive to surprises. The balance of risks will hinge on whether growth and inflation stay within the narrow band needed for a soft landing, and whether AI and other secular themes can keep delivering the profits that are now priced in. Keep an eye on long-end yields, gold, and the earnings trajectory of the largest tech names as key signposts. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.